What's up guys, welcome to another Magic FX YouTube video. In this video I'm going to be explaining to you why I think going with the current flow of price on the 15-minute is so much better than doing top-down analysis from the higher time frames. So what I ought to get into first is what I really mean by following the current flowing ranges on the 15-minute. And really it's an alternative for me to doing multi-timeframe analysis, kind of top down, going from the weekly all the way down to maybe the 15-minute or the 1-minute even. And, you know, that is something that I used to do. You see videos of me doing it and, you know, it can be very successful. And what you have to bear in mind is that that kind of multi-timeframe analysis, where you're looking at the daily, the weekly, the 15-minute, all that, seeing how it ties together, is really, really good if you are targeting those higher RR trades, such, you know, 10 plus R, where you really want to get into those pinpoint areas where you're expecting a much larger, on a larger time frame, reaction to those zones. However, is that really necessary for intraday trading? Is the question that I want to ask. If we are targeting 1, 2, 3 RR on the 1-minute time frame, do I need to know what's going on the weekly? Do I need to know what's going on the daily even? And do I need to know what's going on even on the 4-hour? And the answer for me is no. I just use the 15-minute and the 1-minute to see what's currently moving in price, because I don't need price to move a lot in my session in order to get enough pips to hit that 1, 2, 3 RR target. So for me, it's a waste of time to even consider what is going on say, the weekly. You know, back in the past, I'd have been looking at, you know, the overall swing structure back in, this goes to 2006, and I'd be like, right, if we start up here, you know, we're following price down, we'll probably have this is a big leg coming down, then we come up, then we break that, we've got a swing structure here, we're coming up, and we ranged for an eternity over here before then coming to break this low left here. And then again, we had kind of a sweep of that low and what I would have called minor structure here. Then we've taken out that minor structure, come into the major, come up, blah, 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 blah. And then when I've got this, you know, here's the low, here's this low. Now we pull back up into the premium of this leg or this swing range, and we're probably getting reactions here. What is this doing for me when I'm just trading on the 15-minute intraday, looking for that couple of R? Nothing. Really nothing. A bias is of no use to me. I don't want to have a bias in the markets, because on the 15-minute, price is moving up and down all the time, and I can get involved on those movements without needing that overall bias. I can get involved in a pullback like this. I can get involved in the overall move down like this. It doesn't really matter because I only need those few pips. So what is really great about going with the current flow of price is that you throw expectations out the window. So if you have this weekly, daily bias or whatever, you have an expectation of what price should do in that session. And I'm not saying, you know, for a lot of strategies, that is what you need. You want to have that bias. It helps people psychologically. If you don't want to be taking trades every day, just stay out of the market if, you know, a setup appears that is against your bias, and that's absolutely fine. But for me, it's unnecessary. And especially if I'm just using 15-minute, look, it goes up, it goes down, it goes up, it goes down, blah, 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 blah. Overall, yes, you could say we're moving bearishly. But what you'll find is that even in these bearish legs, you will have bullish moves that give enough RR to work out. So what I use is a concept that I've always used. It's cemented candles, so cemented lows and cemented highs. That forms my current flowing ranges of price. So if I'm just marking from the bottom here, I'd have had this leg up here, then we cemented the high here, and then we cemented the low up here, and then we created some bearish price like this, cemented the low there. Now within this, what you can see is that if I was looking at this, I'm looking at this first range here, and I'm looking, did price come down into the discount? Yes, it did. And I'd have been looking for trades in here once price came down on the 1 minute. And it's really as simple as that. Now to the left as well, you know, what I'm looking at are, if I start up here, we've got the ranges coming down from here, and then we had another one here, and then we had another one here. And you can see we have a kind of a string of unmitigated premiums going along here. Now what I look at to stay with current price is that if I have a range that was unmitigated, the premium, I will still have that open for business as well as the current one. And you can see what we have here is we popped up into the premium of this current range, had a reaction, again probably enough for a 1-to-1, 1-to-2 maybe on the 1 minute. But then overall that reaction didn't break the low. We could have got in long here, and then what it did, it came up into this still open for business premium up here, and we could have taken a short from there that overall still worked out. So you can see there's always a chance to take either longs or shorts, and if one doesn't work out, the other most likely will. And so the benefit of not having a bias in this situation is we're never trying to be right. We don't have an expectation of being right or wrong in terms of a bias, because really the markets can be so random. We never know exactly when they're going to go down and in what form that is going to take, whether it needs to sweep something above and all that. So what this gives us is just high probability areas for a reaction. And so we're always getting involved in those reactions, okay? You can see here that this candle, again, didn't tap this valid zone down here. So this was also still open for business. And what happened? We had a lovely reaction there for longs. So there's multiple examples just in these few little ranges here that we've got. We have a bearish open business here. We have a bearish open business here. One trade from there. We have a bullish open for business down here. We get a trade from there. This open business gets tapped into. We get a potential trade from there. This open for business, still open because we didn't tap a valid zone. We get another trade from there. I guarantee you on the 1 minute, at least one of those will have given us a winning trade, and would come out overall on top. Now, obviously the Phoenix management system and the 1 minute entries are a vital part of this in order to stay profitable and actually make the most of these moves. But the actual analysis and where we're getting involved in price is very simple and allows for trades every single day. I don't think I've had a day trading the 2 pairs that I do that there hasn't been a trade. Some people in Phoenix trade 3 pairs, and there's definitely not a day where there's not a trade. And you see how they can trade multiple pairs, even though it's intraday, but it's so simple, so easy. It's always very clear what you're looking for on the 15 minute and on the 1 minute as well. And again, you know, if we just carry on through price, maybe through a session here, we can see this would be my London session down here. And what do we have? We have a range like this. This was going up. We came in to the discount and pushed up, enough for a long. There was also the opposing bearish range here. Price comes up, taps into the premium of that, pushes down. You take a long, it might have worked out. You take the short, it's definitely worked out there. Okay, you're not guessing, you're not thinking to yourself, oh, is on the weekly this is supposed to be doing this. You're not waiting for swing structure to break. You're not expecting anything. It's all just very simple. There are no complex concepts here. There's no, anything with a fancy name. We have open for business ranges and we have closed for business ranges. And that's pretty much it on the 1 minute and the 15 minute. It's not trying to be clever. And so that is the reason why I like to trade with the flow. I like to go with the flow. I don't like making things too complicated. Yes, it makes sense if you're going for higher RR to do that. For me, my lifestyle, my psychology, the way I like to trade, keeping things simple, having that 1 3-hour session that I can guarantee I'll get a trade in, that's perfect for me. So I hope this gave you some understanding of how I'm viewing the charts these days. And thank you for watching, and stay tuned for more videos.